If you want to understand what's really happening in the markets, stop watching headlines. Stop watching the daily scoreboards. Start watching the plumbing. Because the biggest risks in finance don't announce themselves with breaking news banners. They build quietly underneath the surface while everything looks normal. Right now, most investors believe the danger comes from what happens during market hours, from what the Dow does at 9:30 a.m. or what the Fed says at a press conference. That assumption is comfortable and dangerously outdated. The modern financial system doesn't wait for the opening bell. It moves on autopilot. It moves through futures, through derivatives, through systems that don't care whether you're at dinner with your family or asleep on your couch Sunday night. And here's the uncomfortable truth. By the time most people realize something has changed, the change has already happened. This isn't about predicting a crash. It's about understanding when control quietly shifts away from individuals and into systems, and how that shift always happens before the public conversation catches up. Tonight, we're not going to talk about fear. We're not going to talk about hype. We're going to talk about structure. Because once you see how the system actually works, you stop asking, what just happened? And you start asking a much more important question. How did I miss the signal while I was watching the noise? Pause. Let's reset the lens before we look at the data. Most people are taught to look at markets the same way they look at sports scores. Up one day, down the next, winners and losers, red or green. It's simple, it's visual, and it's almost completely misleading. Mainstream financial media focuses on events, earnings reports, Fed speeches, elections, quarterly GDP prints. Those things matter, but they are surface-level triggers, not root causes. They explain movement, not mechanism. The real drivers of market stability sit much deeper. They live in liquidity flows, balance sheet constraints, leverage, and incentives. They live in systems that don't care about optimism, narratives, or long-term fundamentals in the short run. Here's the mistake most investors make. They assume markets behave rationally because humans participate in them. But modern markets are not primarily driven by humans. They're driven by systems reacting to other systems, algorithms responding to volatility, funds responding to rules, institutions responding to risk limits, and governments responding to political constraints. That's why markets can fall even when nothing bad happened, and why they can rise even when the economy feels weak. When something breaks structurally, it doesn't announce itself with a headline. It shows up as strain, bid-ask spreads widen, volatility rises before prices fall, correlations snap, assets that normally move independently suddenly move together. Most commentary misses this because it asks the wrong question. What news moved the market today? The better question is, what pressure has been building quietly that made the system fragile before the news? That's the lens we're going to use. Not prediction, not panic, structure. Now that the frame is reset, we can look at the actual data calmly, precisely, and without drama. Let's slow this down and separate what is verifiable from what is speculative. First, the global bond market. U.S. Treasury securities are the backbone of the financial system. They're not just government debt, they're collateral. They're the reference point for pricing everything from mortgages to equities to derivatives. Over the past several years, foreign ownership of U.S. Treasuries has been steadily declining. According to publicly available Treasury data, major foreign holders, including China, have reduced their exposure over time. This hasn't happened all at once, and it hasn't been dramatic on any single day. But the trend is clear. The marginal buyer of U.S. debt is increasingly domestic institutions and the Federal Reserve itself. Second, interest rates. The U.S. 10-year Treasury yield has moved to levels not seen in over a decade. This matters because Treasury yields are the baseline for financial valuation models. When yields rise, borrowing costs increase across the economy. Corporate debt becomes more expensive. Mortgages become more expensive. And future earnings are discounted more aggressively. This isn't theory, it's how discounted cash flow models work. Third, equity concentration. A historically small group of large technology companies now represents a significant portion of major stock indexes. This concentration means index-level performance is far less diversified than it appears. When leadership narrows, markets become more sensitive to shifts in sentiment, liquidity, or valuation assumptions. Fourth, leverage. Margin debt, money borrowed to invest, has grown meaningfully over the past decade. driven by low interest rates and a long period of market stability. While leverage can amplify gains, it also introduces nonlinear risk. Losses don't scale smoothly. They accelerate when certain thresholds are crossed. Fifth, market structure. Today's markets rely heavily on algorithmic and rule-based trading. Many funds operate under strict volatility, liquidity, or drawdown constraints. When those thresholds are triggered, selling occurs automatically, not emotionally, mechanically. Finally, trading hours. While U.S. stock exchanges close on weekends, futures markets and global asset markets do not. Price discovery continues through international venues, derivatives, and correlated assets. This is why markets can open significantly higher or lower than where they closed, what traders call gaps. None of these facts are controversial. They are structural features of the modern financial system. The key point is this: when multiple pressures exist simultaneously, higher rates, concentrated leadership, elevated leverage, and automated responses, the system becomes more sensitive to shocks. With that foundation in place, we can now ask a deeper question. What might these facts mean strategically when viewed together? When we step back and look at these facts together, a few strategic patterns begin to emerge. Not certainties, but possibilities that help explain why the system feels more fragile than headlines suggest. One possible interpretation is that markets are currently priced for continuity. Valuations, positioning, and risk exposure largely assume that liquidity will remain available, that volatility will stay contained, and that central banks retain full flexibility to intervene if something breaks. That assumption has held for most of the past decade. But this may be changing. Higher interest rates alter the calculus for every participant in the system. For governments, servicing debt becomes more expensive. For corporations, refinancing risk increases. For investors, the relative attractiveness of risk-free returns improves, subtly pulling capital away from risk assets. At the same time, the concentration of market leadership means that stability depends on a narrow set of outcomes continuing to go right. When many portfolios, directly or indirectly, are exposed to the same few assets, diversification becomes more fragile than it appears on paper. Another strategic consideration is leverage. In a low-rate environment, leverage can feel benign. But as rates rise and volatility increases, leverage stops being a tool and starts becoming a constraint. Positions that look manageable under normal conditions can become untenable very quickly if prices move against them or liquidity thins. This is where market structure matters. Rule-based funds, volatility targeting strategies, and risk parity models don't decide to sell. They must sell when inputs change. If volatility rises or correlations shift, these systems reduce exposure automatically. That behavior can amplify moves that initially began as relatively small adjustments. It's also worth considering the role of policy response. Central banks have been highly effective at stabilizing markets in past crises. However, elevated inflation and political constraints may limit how aggressively they can act without creating other problems. This doesn't mean intervention is impossible, but it may be slower, more cautious, or more selective. Taken together, these factors suggest a system that is less resilient than it was when rates were near zero and liquidity was abundant. Not because any single element is broken, but because multiple buffers are thinner than they used to be. This doesn't guarantee a crisis, but it does increase the probability that small shocks could have outsized effects. And when systems become sensitive, the consequences rarely stay confined to one market. Which brings us to the next layer. What happens if these pressures cascade beyond asset prices and into the broader system? If these pressures do begin to cascade, the effects wouldn't stay neatly contained within the stock market. Financial systems are interconnected by design, and stress in one area tends to migrate, often in ways that aren't immediately obvious. Start with markets. When volatility rises and liquidity becomes uneven, correlations increase. Assets that normally behave differently begin moving together. This is why diversification can fail precisely when investors expect it to protect them. Stocks, corporate bonds, and even some alternative assets may all experience drawdowns at the same time, not because they share fundamentals, but because they share funding sources and risk constraints. Banks sit at the center of this web. While the U.S. banking system is better capitalized than it was in 2008, it still relies on confidence and stability. Banks hold large portfolios of bonds and loans whose values are sensitive to interest rates. Rapid changes in rates or market prices can pressure balance sheets, even without widespread defaults. When confidence wavers, lending standards tighten and credit availability shrinks. Currency dynamics add another layer. Traditionally, periods of market stress strengthen the US dollar as global capital seeks safety. But if stress is tied to rising debt costs, fiscal concerns, or policy constraints, currency behavior can become less predictable. Volatility in foreign exchange markets often feeds back into global trade, commodity pricing, and emerging market stability. Governments, meanwhile, face trade-offs. Supporting markets, stabilizing banks, controlling inflation, and managing public debt are goals that can conflict with one another. Policy responses may therefore be uneven, effective in some areas, slower or more cautious in others. That uncertainty itself becomes a source of instability. On a global level, these dynamics can accelerate shifts already underway. Countries reassess supply chains, central banks diversify reserves, trade relationships adjust. None of this happens overnight, but periods of stress tend to compress timelines that would otherwise unfold gradually. The key point is this: systemic consequences aren't usually dramatic at first. They show up as tightening, tighter credit, tighter liquidity, tighter financial conditions. Over time, that tightening affects economic activity, investment decisions, and confidence. Which brings the discussion closer to home. Because when systems adjust, the effects eventually reach everyday life. Not all at once, but steadily enough that people feel the change before they fully understand it. That translation from macro pressure to personal reality is where this becomes real for most people. This is the part where abstract systems stop being abstract. When markets tighten and financial conditions shift, the first thing most people notice isn't a headline. It's a change in how normal life feels. Start with savings and investments. For many Americans, retirement accounts are the primary connection to financial markets. When volatility rises and returns become less predictable, account balances fluctuate more sharply. Even if nothing is sold, the psychological impact matters. People feel less secure, and that feeling changes behavior. Spending slows. Major purchases get postponed. Home renovations wait. Cars get driven a little longer. Vacations are delayed. That collective pause ripples outward, affecting businesses that depend on discretionary spending. Jobs feel less stable. Companies respond to uncertainty by freezing hiring, reducing bonuses, or cutting back on expansion plans. Layoffs don't usually come first, but opportunity dries up before anyone announces it. Wage growth slows. Job switching becomes riskier. People stay put even when they're unhappy because uncertainty changes risk tolerance. Housing becomes harder to navigate. Higher interest rates mean higher monthly payments. Buyers qualify for less. Sellers hesitate. Transactions slow. Even people who aren't moving feel it, because housing costs influence everything from property taxes to rent negotiations. Cost of living pressures don't disappear just because markets are volatile. In fact, certain costs, insurance, healthcare, utilities, tend to rise regardless of market performance. When asset growth slows but expenses keep climbing, households feel squeezed from both sides. Families adjust quietly. College plans get reconsidered. Retirement timelines shift. Adult children move back home. Parents worry more about helping kids while protecting their own future. None of this makes headlines, but it shapes real lives. The important thing to understand is this: economic transitions aren't experienced as single dramatic events. They're experienced as a series of small constraints that accumulate over time. Recognizing that pattern early doesn't eliminate risk, but it does give you agency. And agency starts with having a framework for thinking clearly when the environment changes. That's what we'll build next. This is where most financial content stops and where long-term thinkers begin. The framework I want to give you is something we'll call the structural lens. Instead of asking, what should I buy? The structural lens asks, what forces are shaping the system right now? It's a way of thinking that strips emotion out of decision-making and replaces it with orientation. Here's how it works. First, separate price from structure. Price moves fast, structure changes slowly. When prices swing wildly, most people react. When structure shifts, most people don't notice, until much later. The structural lens trains you to focus on the slow-moving constraints: liquidity, leverage, incentives, and policy limits. Second, identify who is forced to act. Markets aren't moved by opinions. They're moved by constraints. Ask, who must buy or sell under certain conditions? Leveraged investors, rule-based funds, institutions with regulatory or liquidity requirements. Forced actors matter more than confident ones. Third, watch the buffers. Every system has shock absorbers, excess liquidity, policy flexibility, strong balance sheets. When buffers are thick, shocks are absorbed. When buffers thin, small disturbances travel far. The question isn't, is there risk? There is always risk. The question is, how much cushion is left? Fourth, track second-order effects. Most people focus on first reactions. The structural lens looks at what happens next. Not just market moves, but behavioral shifts, changes in spending, hiring, lending, and confidence. This framework doesn't tell you what will happen tomorrow. It helps you understand why certain outcomes become more likely over time. And once you start thinking this way, you stop chasing forecasts. You start positioning your thinking for uncertainty. That's the foundation. Now let's talk about how to translate that mindset into practical preparation without panic and without prediction. Preparation doesn't mean making extreme moves, and it definitely doesn't mean trying to outsmart the market. Using the structural lens, practical preparation is about reducing fragility and increasing flexibility. Start with awareness. Know where your exposure actually is. Many people think they're diversified because they own multiple funds, but those funds often rely on the same underlying drivers. Look through the layers. Ask, what assumptions does my financial life depend on? Stable markets? Low rates? Constant growth? There's no right or wrong answer, only known versus unknown. Next, think in terms of liquidity, not returns. Liquidity isn't just cash. It's access. It's optionality. It's the ability to respond when conditions change. In uncertain environments, flexibility has value that spreadsheets don't capture. Being forced to act at the wrong time is often more damaging than missing upside. Then reduce reliance on leverage, financial and personal. This doesn't only mean margin debt. It means high fixed expenses, tight monthly budgets, or plans that require everything to go exactly right. Systems fail when there's no room to absorb shocks. Personal finances work the same way. Pay attention to signals, not predictions. Watch volatility trends, credit conditions, lending standards, policy language. These don't tell you what will happen, but they tell you how the system is feeling. Systems often show stress before they break. Most importantly, slow your decision-making when emotions run high. Periods of uncertainty create urgency, but urgency is rarely your friend. The goal isn't to be early or clever. The goal is to avoid irreversible mistakes. This mindset may feel conservative in a culture that celebrates boldness and speed. But over time, resilience compounds just as reliably as returns. You don't need to forecast the future to navigate it well. You need clarity about what you can control, what you can't, and where fragility might exist. That's preparation, not panic. And with that clarity, we can end where we began, not with fear, but with perspective. If there's one takeaway from all of this, it's not that danger is imminent. It's that stability is conditional. For a long time, many people were rewarded for not thinking too deeply about how the system worked. Markets recovered quickly. Policy backstops were reliable. Mistakes were forgiven. That environment shaped habits and expectations. But systems evolve. Moments of transition don't arrive with sirens. They arrive quietly as assumptions stop working the way they used to. The people who struggle most aren't the ones without information. They're the ones relying on old mental models in a new environment. This isn't about being pessimistic. It's about being structurally aware. When you understand how incentives, liquidity, and constraints interact, you don't need constant reassurance. You don't need dramatic forecasts. You don't need to react to every headline. You gain something more durable, orientation. And orientation is what allows you to move through uncertainty without panic, adjusting when necessary, staying patient when others rush, and protecting what matters most over the long run. The world doesn't change all at once, but the way you see it can. That's where real preparation begins.